The Fed can move the entire real estate market without even touching a single mortgage rate. That's right, they don't have to raise or lower your mortgage rate directly to make homes more or less affordable. One sentence from the Federal Reserve can change how much your house is worth, how fast it sells, and whether a buyer can even afford it. And that's crazy, right? Because while you're watching mortgage rates, a lot of things are sitting quietly behind the curtain, pulling the strings of money, supply, inflation, and lending confidence. And today, I'm breaking down exactly how they do it, what's really happening behind those Fed meetings, what it means for you, and how to stay one step ahead of everyone else in 2025 rolling into 2026. In reality, many people, even many agents, don't really understand how the Federal Reserve drives real estate. We all see the headlines like Feds holds rates steady or Powell signals future cuts, and the next thing you know, mortgage rates shift overnight. Home buyers panic, sellers freeze, and the entire housing market changes its mood. Understanding this isn't about becoming an economist. It's about protecting your biggest investment, your home, your equity, your wealth. Hi, my name is Rima Rafeh, broker and team leader of the Rafeh Group here with eXp Realty. And on this channel, I don't just talk about listings, I help you understand the market like a pro. If you want clarity, not hype around the real estate economics and wealth building, you're in the right place. Hit the subscribe button and let's jump right in. Let's explain the Fed. The Federal Reserve is America's central bank. Their main job is to keep the economy stable, balancing inflations, jobs, and growth. But here's what most people miss. The Fed doesn't set your mortgage rate. They set the federal funds rate. The interest rate banks charge each other for overnight loans. That sounds boring, right? But that single number influences everything. Credit cards, car loans, business borrowing, serving rates, and yes, eventually mortgage rates. When the Fed raises rates, banks borrow money at a higher cost, so they charge you more for loans. When the Fed lowers rate, borrowing gets cheaper, which encourages spending, investment, and yes, home buying. They also control money flow by buying and selling government bonds. When they buy bonds, they pump money into the economy. That's like turning onto the faucet. When they sell bonds, they pull money out, tightening things up. Every one of those moves ripple through Wall Street, then Main Street, then your living room. Let's give you an example. 2020, when COVID hit, the Fed slashed rates to near zero and start buying bonds aggressively. The result? Mortgage rates dropped to historic lows under 3%. What happened next? Buyers flooded the market. People were buying homes sight unseen. Prices exploded. Equity soared. Fast forward to 2022, 2023, the Fed reserve course inflation got out of control. So they hiked rates at the fastest pace in 40 years. Mortgage rates doubled, affordability collapsed, and suddenly the hottest housing market in US history hit the brakes. Do you remember that shift? Were you one of those buyers or sellers caught in it? Drop a comment below and I would love to know what it felt like in your city when rates shot up. So let's go on one layer deeper, because here's where people gets confused. The Fed doesn't sit around deciding your 30-year mortgage rate. What mortgage rates actually follow is the 10-year Treasury yield. That's what big investors use to measure safe returns. When the Fed hints at future rate hikes or cuts, the entire bond market reacts instantly. If investors think inflation is under control, yields drop and mortgage rates follow. Let me put it in real-world terms. Think of an investors like crowd watching the Fed's press conference. The Fed doesn't even have to do anything. Just say something and everyone in the room moves their money based on what they think will happen next. That's why you'll see mortgage rates drop or spike before the Fed even officially changes anything. Here's how sensitive it is. Let's say you are buying a $700,000 home. At 6% interest rate, your monthly payment is roughly around $4,200. At 7%, that jumps to $4,600. That's the difference, is $460 a month, $5,500 a year, all because of how investors interpreted a Fed statement. That's how powerful their influence is. It doesn't just shape numbers on chart, it shapes people's lives, decisions, and futures. So you might be asking how this all play out in housing. So when the Fed raises rates, buyer affordability shrinks, loan approvals tightens, sellers lose leverage, and home sits way longer on the market. And when the Fed cuts rates, we see the total opposite. Demand floods back, bidding war returns, and price rise faster than supply can catch up. And that's the cycle we're living through again in 2025. I'll never forget one of my clients from 2021. They bought a house for $900,000 at 2.9% interest rate. Payment was just under $3,800. Their friend waited until 2023, same house, same price range, but rates was at 7%, payment was at $5,400. Same budget, different timing, all because of the Fed's rates path. That's why when people say I'm waiting for rates to drop, I always remind them, when rates drop, competition surge. The same home that we're starting getting 10 offers again and again. So you don't just need to watch what the Fed does, you need to understand how buyers will react to it. And here's the part even seasoned agents overlook: the lag effect. Financial markets react to the Feds in seconds, but real estate reacts over weeks and months. It takes time for buyers' confidence to return, for sellers to adjust prices, and for the lenders to reprice products. That 1 to 3 months lag is to your advantage. So if you're a seller and you know the Fed is signaling future cuts, list slightly ahead of the crowd. If you are a buyer, start getting pre-approved before the herd, because by the time the news headline says rates drop, the market will already be moving. So I had a listing last year where we timed it perfectly. The Fed announced it might show rate hikes. Mortgage rates hadn't budged yet, but we launched the home the next week. In 3 weeks, rates dropped 0.5%, buyer traffic doubled, and we sold that home $30,000 above list price. That's what understanding the lag does. It turns information into profit. Every time the Feds meet, the housing market holds its breath, because even if you don't trade stocks or bonds, your financial life corrected to what they do. In the 1980s, inflation was sky high, raised rate to nearly 20%. The housing market collapsed, but it crushed inflation. Fast forward to 2020, rates dropped to historic lows, fueling a housing boom and wealth explosion. Now in 2025, the Fed is again at crossroads, inflation cooling, but affordability is stretched thin. The next few moves will shape an entire generations of home buyers. In high-cost markets like Los Angeles, Santa Clarita, or the Bay Area, even a quarter point change in rate shifts affordability by tens of thousands of dollars. That's why I tell my clients it's not just about when you buy, it's about what the Fed's tone is when you buy, because the confidence moves buyers just as much as rates do. When the Fed signals stability, people feel safer. They start to dream again. When they sound hawkish or uncertain, people pull back, not because the math changed overnight, but because the mood did. And mood drives momentum. So what can we expect next? Different scenarios can happen. Scenario 1, Fed cuts rates, buyer demands will surge, and prices climb modestly due to a limited inventory. Great time for sellers to list, but buyers must act fast before appreciation eats up savings. And scenario 2, Fed holds steady. Slow but steady sales. Balanced market, buyers regain negotiation power. Smart sellers focus on presentation, not pricing wars. And scenario 3, Fed hikes again. Temporary market chill, investors pause, refinances stop, but serious buyers still buy because they know rates are temporary. So the real question isn't what the Fed will do, it's what you'll do with the information. Because while everyone else reacts, smart homeowners and investors prepare. So don't fear the Fed. Understand it. Use the signals as your map. When they tighten, look for opportunities in negotiation. When they loosen, position yourself early for the wave of activity that's coming. One of my investor clients watches the Fed calendar religiously. When rates started rising, he bought fixer properties while others hesitated. He knew once rates drops, buyers would return. And guess what? He flipped 3 homes for 22% return on investment. That's not luck. That is strategy. So whether you are a homeowner, a future buyer, or just someone trying to make sense of this economy, remember this: the Fed doesn't control your life. They control the environment you operate in. But your results depend on your response, your timing, and your guidance. That's where experience comes in. If you're wondering how to read these shifts, how to price your home correctly, or how to position yourself for 2025, please reach out. I help clients understand the economy and the market every single day. Not just when it's easy, but when it's confusing, because that's where opportunity lives. So now it's your turn. What do you think the Fed will do in 2025? Cut, hike, or hold? How do you think it will impact your local housing market? Drop your prediction in the comments and let's see who gets it right. If you find this helpful, hit that like button, subscribe for more, and share this with someone stressing about mortgage rates right now. And remember, knowledge is leverage. When you understand the Fed, you control your real estate and your future. And don't forget to like, comment, and subscribe, and we'll see you on the next one.